Okay, so that sums up all of the biggest headlines of the day of trade on Wednesday. Just taking you through what the market moves have been. It's a 2.1% shave off coming in on the Nifty. Its biggest intraday fall since March of 23rd March this year. 516 points lower on the Nifty 50. We've not even been able to hold on to the 23,900 mark. 23,882 to be precise is where we've shut shop on the Nifty 50. For the Sensex, it's close to a 1,700 point fall coming in on an intraday basis. The India VIX spiked up 30% at one point of the trading day, ended with a spike of 26%. So that is also something to watch out for the day of trade on Thursday. The broader end of the market was also deeply under pressure, a 1.6% cut on the mid cap, almost a 2% cut coming in on the small cap index. But it was the PSU banking space as well as the private banks that were under pressure. Nifty Bank, all in all, was lower by close to 1,500 points, a 2.5% cut coming in over there as well. From the Nifty 50, you had about 46 stocks in the red with only 4 in the green. That also led ahead by ONGC, an upstream company that benefits when crude prices surge. On the flip side, it was Interglobe Aviation lower by 5%, Geo Financial, Shriram Finance, Maruti Suzuki. These were your top Nifty 50 losers. What really stands out is the breadth that we've seen in the broader end of the market in the ratio 1:6. So for every one stock that was in the green from the Nifty 500, you had 6 stocks that were under pressure and in the red. So that's the kind of tilt that we've seen in the broader end of the market, and that largely sums up the kind of trading day. Of course, all of this pressure in the last couple of hours for the market on the back of Donald Trump's comments on how he believes that the MOU of ceasefire between the US and Iran is now over, and he does not want to indulge in any further peace talks. At least that's the comment that we've heard coming in from Donald Trump as of now. What is the impact on oil sensitives given the sharp spike that we've seen in levels of Brent? What are experts penciling in for Brent itself in terms of some levels? We've got Mr. M.K. Surana, former CMD at HPCL, joining us on the show, along with Yogesh Patil, the Director Research of Oil and Gas at Daulat Capital. Mr. Surana, let's start with you. Talk to us about how you are reading into the comments coming in from Trump, and more importantly, the impact that it has had in terms of the spike that we've seen on the Brent.
Yeah, good evening, and thanks for inviting me to your show. As far as the comments of President Trump is concerned, we also need to see what comes on Monday again. So there had been a number of times when the comments have been made that the MOU is off on. So right now, immediately it will be early to comment on that. But two things we can probably make out that there is a flexing of muscles from Iranian side. They believe that they have got the cards in their hand, and they will try to extract maximum out of the negotiation as it goes. As far as US is concerned, their options are slightly limited, especially with the president election because of the November election coming in. And therefore, this negotiation can be a long-run negotiation, especially basis the extreme positions which the two sides have taken. Now, in this context, the oil prices will move up and down depending on the news flow, which happens every day, and you may see a high volatile period during the period of negotiation. As far as market is concerned, I think the market still believes that it is not going to lead to a kinetic action, because I don't think US is having appetite to go for a full-fledged military action again. And in the morning, the US government has said that whatever they were supposed to retaliate, they have done it. So the further actions will depend on how the two sides respond to that. In this context, 2-3 things we need to be conscious about. If it doesn't lead to a long-run war type of situations, then the market will remain volatile, but it will remain in a range-bound fashion. The lowest we have seen is 70, and the upper side, I don't think going beyond 85. But if it actually get to a really a kinetic action and a warlike situation, then the options will be limited, because earlier we had a benefit of the high buildup of inventory in China just before the war, and also the large quantity of oil held in SPRs. Now, both have been reduced over a period during last 4 months, and if at all it gets to a long-run war, then the spike may be more sharper, and the impact will be more. So in overall basis, I still believe, and I think the market also believes, that's why the action is there in as far as the price bump is concerned, but it is not to the extent it could have been had it been seriously considered as a restart of the war. But the second point is that US also has said that they are removing the relaxation which was given on sanction on Iran oil. But that was the case because what the Iranians have put out the oil from the Strait of Hormuz, that was not being bought by the people, and it was floating on the sea because of no clarity from the US side regarding the sanction removals. And I think that may be the reason why hardening of the stand from the Iranian side also. If they cannot sell their oil, what is the point on them to relax the grip on Hormuz? But all said and done, I think the Iranians have realized that the Strait of Hormuz is an important leverage which they have, and they will try to press it to get the maximum out of the negotiation deal which they have. And in future also, this can be used not only in the Strait of Hormuz, but the other maritime passages as well.
Okay. Mr. Yogesh, I'll come to you in just a minute. Hi, this is Harsha. Mr. Surana, if I can add on to that question, if the status remains as is today, how much of the spike have we already seen? How much to go, in your opinion? I know, difficult call, but your sense.
I think 85.
95. Okay, 95
85,
on crude. 85. Okay. 85 on
like
crude.
This, and there is no further escalation.
Okay, yeah, perfect. Okay. Yogesh, let me come to you. Impact, second order impact. OMCs, upstream. Give us a sense.
Yeah, good evening.
Good evening.
So even I'm agree with the Surana sir regarding the if the current situation remains the level, then the $85 per barrel will be a kind of a capping to the oil price. It is not going to cross. But now the question in the investor mind at this point of time, whether the mini oil glut, which we were seeing in the last couple of weeks or a couple of days, is it over or still left? So some stranded oil was there at the Persian Gulf, which has come out from the Strait of Hormuz, and it was around 160 million barrels, and out of which the floating storage, it was a kind of a floating storage at a Gulf and has already exited the Persian Gulf. So what happened in the last 2 weeks is a kind of a mini oil glut, and during this ceasefire period, out of these 160 million barrels, Iran has sold approximately, to our knowledge, 60 to 70 million barrels, and the remaining was the Gulf nations oil. In the result of this was a mini glut. Physical oil market was quite weak on the pricing side, and there were no buyers for the same crude oil, as the most of the countries like India, Japan, Korea have already tied up for the next 2 months for the crude supply. But now the situation has changed. The president of America has already mentioned in one of the interview that the MO is over and now they don't want to deal with the Iran. What is the meaning of this statement to the oil market? To my understanding, oil supply side, Iran has already weaponized the strait. The flow of oil will again to slow down. Inventories of the major oil consuming and the importing nations like United States and the Europe have already touched to the lower levels or reduced levels. So this is on the supply side. Unlikely, and the going forward, what we expect on the demand side, that oil demand can be balanced by the China. The China has remained as a shock absorber during the last 3-4 months during all these volatile period. So we continue to expect China will play the same kind of a role, and that's why we expect oil prices will remain $85 per barrel at a cap in the current situation, if the situation is not further escalating. On the OMC side, at this point, even at $78 to $80 per barrel, the oil marketing companies on an integrated level are earning more than 10 rupees per liter kind of a margins. So that is not an issue immediately, but as a ballpark understanding is that as every $1 per barrel increase in the oil prices, dent or impact on their gross marketing margins, approximately 50 paisa to 60 paisa per liter. So in that kind of a situation, the oil marketing companies, I mean, they are into a kind of a double whammy situation. One, in the coming days, they are going to report heavy losses kind of a numbers of the Q1 FY27, and on the top of that, recently, I mean, in just few hours, we are seeing again the war has started. So the volatility definitely will be there in the oil marketing companies.
What's the break even, Yogesh, on this one? What's the break even, and how much according to you should be passed through in coming days?
So at this level, 78 or even 80 or $85 per barrel, I don't expect, even my financial modeling is not expecting any kind of a price increase on the petrol and diesel.
Okay.
I hope that's the your question.
Yes.
Pass on. Yeah.
That.
So at $85 per barrel, I don't think so OMCs will start bleeding on their marketing margins or even on the integrated margins. But there are two scenarios. $85 per barrel, what we seen on the screen as a one month forward prices. But generally, in case of OMCs, they procure the crude in the physical market at a spot level, and in this kind of a tight situation, they generally pay the premiums. If they have to pay the premium of $5, $10 per barrel, in that situation, there might be a further price increase on the petrol and diesel. But I don't expect as of now at $80 per barrel, there will be a further price hikes into the petrol and diesel.
Understood. That sounds optimistic for us as consumers. Mr. Surana, same question to you. What do you believe in terms of what do you believe the next action for pricing will be for OMCs given the kind of impact that we're seeing in crude? And also on the aviation front, what's going to happen to ATF fuel? Because aviation is a sector that gets hit really badly when there is even a little bit of a spike in crude prices.
So as I mentioned to you that right now, with the current situation, if it remains like that, we are not expecting a price going above 85.
Okay.
But currently, there is a lot of oil in the market, and actually, because the OMC tie up almost 2 months next oil is already tied up, so that oil is bought at a higher price. First part. So right now, what the price is, that is lesser than at which the oil companies would have bought the oil, which will be processed right now. Now, going forward, if the prices remain like that, actually there will be a situation where they will have the cheaper oil than what it was. That's one part. Second part is what I understand is there is a discount available on some of the floating oil, which is currently available. So oil companies may like to tie that up on the spot basis. I don't think there is a possibility of reduction in price at all of petrol or diesel in the current market, not only because there is a sudden spike in the crude price again, but otherwise also I was mentioning even day before yesterday also I mentioned that this is a delicate situation and these are fragile truths. So it will go ups and downs and the oil prices will move. The second part is they already have a lot of under recoveries. The government also has got reduced the excise duty. So it will be a while, even if the prices remain low, to reduce the prices of the pump. So I would assume that the prices will remain as it is without an increase or a reduction if the crude prices remains below 85. The another thing which we need to watch out is the dollar exchange rate. The exchange rate is still hovering around 95. So it is not only the crude price per dollar per barrel, but also the exchange rate per dollar. The both will impact the recoveries or under recoveries of the oil marketing companies.
Understood. Yogesh, while that is the impact on aviation, I also want to talk to you about a bunch of other oil-sensitive sectors. Also weigh in on your view when it comes to aviation. But what about rubber? What about tires? What about paints, for example? What is going to be the trickle-down effect of this spike that we've seen in crude prices? It's not like the situation hasn't played out in the past. In fact, it's been the case very recently. But now that this situation has come back out of nowhere, what is going to happen to the Q2 earnings of some of these companies?
So, frankly speaking, we are not covering any rubber companies. But to my limited understanding, of course, the increase in the raw material cost of these rubber entities will have the pressure on their gross profitability and the EBITDA margins also.
Okay. And Yogesh, give us a sense as to, so no increase is likely at the pump. Talk to us about the benefits for upstream, especially. If at all these prices were to sustain, give us a sense of that.
Definitely, if you see the Q1 FY27 numbers of the upstream entities, it is showing a huge bump up in the numbers profitability, considering the Brent average during the Q1 FY27 was $105 per barrel, and the upstream companies are the beneficiary of that. Now, in the last couple of days, we have seen the cooling down in the oil prices, and that's why we have seen the correction in the upstream entities also. But if the momentum of the oil prices remain at the elevated level of $85 per barrel, definitely we will see a kind of positivity into the ONGC in the Oil India upstream player side.
Understood. And your top bets at this point, Yogesh, if you can just give us stock-specific bets.
So we have top bets on the Reliance Industries side.
Okay. All right. So that's the top bet. Mr. Surana, talk to us about the risk at the pump. At the moment, doesn't seem to be the case. At what point do you believe that pump prices need to go up to cushion any sustainable crude increase? Because, and I'm thinking from a structural perspective as well, from an economy perspective, that will likely impact both growth as well as earnings. So I'm trying to get a sense as to how you view it at $85 and at what point should one be concerned?
See, if we see in the last 4 months, even when the crude price was hovering in April and May at above $110, then also the prices were maintained. So in India, especially, the pump prices is not just the function of the crude prices and the product price, but it is also the priority of the government which it fixes. So if the government think that the pump prices should be stable based on the larger macroeconomic factors to ensure that the inflation doesn't go up, the normal common man doesn't get a beating on their budget. So in that case, the pump prices may not change actually. But if it goes beyond, like we saw that it was continuously holding, so somewhere, though the crude price increased to crossed $105 somewhere in April, but the prices were increased after 15th of May. So it is a timing and the priority which the government think and the capacity of the OMCs to bear that loss, because it is not indefinite that you can continue to have the under recoveries. Otherwise, it will start affecting the liquidity also. But I will assume that $85 or so should not give a trigger for increase in price. But if you got a sustained basis above 100 or 105, then probably there may be again a rethinking, because you already have a accumulated under recoveries, and on the top of it further will be difficult to absorb.
Okay, Mr. Surana, Yogesh, it's been wonderful having both of you to do this kind of conversation, kind of rounds it up beautifully to try and help us get perspective on what next with regard to crude. Thank you so much for joining us, both of you, gentlemen.
Thank you.
All right, what we'll do is slip into a short break. On the other side, we'll start to talk a little bit technical in terms of the factors. What are the levels that we look out for tomorrow? It's been a tricky day of trade, mind you. It's going to be even more trickier, if at all, the next few hours before we open up for
impact for sure.
For tomorrow. We'll get a sense of all of that and more. Stay with us.
Back with Market Edge, and before the break we were talking about the kind of spike that we've seen in crude prices on the back of Donald Trump's comments and what impact it could have at the pump, petrol prices of course, as well as on OMCs and oil sensitives. Now let's set you up for the day of trade on Thursday, take you through some of the cues that you should be keeping on your radar. The biggest one of course being we are going to kickstart the Q1 FY27 earnings season with TCS from the Nifty 50 group of stocks being the first one to come out with its earnings as always. What else to be watching out for? Meryl is joining us with just that.
Coming to you with some of the important cues that you should track on the 9th of July. Starting at home, it's the weekly Sensex expiry, so do watch out for volatility in the Indian markets. Globally, from the US, we'll be watching out for initial jobless claims as well as existing home sales data, which is set to be released. From Asia, China's CPI and PPI inflation numbers will be in the spotlight, while Japan as well will be releasing its money stock data. In terms of global earnings, we've got Delta Airlines and PepsiCo in focus. Both are set to report their quarterly results. And in India, TCS kicks off the first quarter earnings season in the Nifty pack. Apart from Nifty names, we've got Anand Rathi Wealth, GM Breweries and JK Tyres also set to report their first quarter results in India. In the primary markets at home as well, Laser Power and Infra IPO will be in focus as it opens for subscription on the exchanges. And the markets will also be watching key commentary coming in from the New York Fed President John Williams, along with Bank of England's Deputy Governor Sarah Breeden. We're also going to be tracking ECB's minutes of the meeting for its June policy meeting for further insights on the rates. So yes, these are some of the important cues that one should track on the 9th of July.
All right, thank you so much for that, Mary. Let me go across. Ajit Mishra from Religare Broking joining us. Ajit, unexpected day, at least, at the very, very least. More cautious with regard to tomorrow's day of trade. What levels does this open us up to?
Yeah, good evening, Anshu. Yes, certainly, because the way we were seeing that it's been almost like a month, exactly a month, that the recent swing lows close to around 23,000 level Nifty hit on the 8th of June. And today on 8th of July, we saw that the first major dent to the markets. Prior to that, we have reclaimed the major averages, 200 days, 100 days, and we were inching towards the previous swing high, close to around 24,600 marks. So there were indications basically that markets may make an attempt of a decisive trend reversal, but it turned out to be otherwise. Means in a single day, we have surrendered all the key averages, including the short-term average. So after this fall, and especially the banking, which was leading from the front, also witnessed a sharp pressure. And since the earnings season is about to get kickstart with TCS number, IT as a pack is anyways, witnessing volatile swings. So definitely it's going to be a volatile day tomorrow. And the way we have ended after defending 23,800 mark, that would be the first area of defense. And then probably around 23,650, the gap area that we have on the daily chart. So 23,650 to 800 will be the area where, bulls might try to form a base. On the higher side, level close to around 24, 150, 300, that might act as a resistance.
Okay, so those are some levels we're going to be watching out for. Ajit, very tricky question to you, but where is the safety net, if at all, in a market like this? Any stock-specific recommendations to try and brace for the impact that we're expecting to see on the day of trade for Thursday?
Means it's very difficult considering that the decline was broad-based in today's session, and we may continue to see this kind of volatility continuing ahead also. But relatively, pharma looks better, wherein the index is trading at the record highs. Majority of the pharma names, they are still holding strong. In today's session also, we were maintaining a sideways to muted stance. So Sun Pharma is one stock from the pharma basket wherein we see strength. So with stop at 1830, one can look to accumulate Sun Pharma with the 2040 as a target area. And as the market tone has turned negative, the underperformers, especially from the FMCG pack like ITC, has given a fresh breakdown. So we anticipate this decline to further extend, and possibly towards 268 is something that the stock might test. So with stop at 288, one can go short in ITC as well.
Long on ONGC, Ajit, upstream.
So after this, sharp correction, we were seeing that both ONGC, All India were witnessing a rebound, means from 225 to 247. We have reclaimed the short-term average, so which is a good sign for ONGC, and probably level towards the long-term average 255, 260 is something that the stock might extend. So it's a recovery play, but since we have seen this kind of volatility unfolding, means even with the sharper uptick in the crude oil prices, we were not seeing a similar kind of traction in All India and ONGC before. So one should definitely maintain a strict stop for ONGC now. This 240 is the immediate base area. So with that as a stop loss, one can definitely look for a rebound trade for 255, 260 as a positional targets.
What about our viewers who already have a holding in names like HPCL, BPCL, IOC, Interglobe Aviation, some of the paint stocks? What if they already have a holding? Should they sell and wait out this entire volatility period, or should they continue to hold?
Susna, it's a tricky one because Crude has definitely witnessed a sharp rebound from 70 to 79 in just a couple of sessions, and indications are in the favor that we are inching towards 82, 83 marks. So possibly reducing your position is first thing that you should definitely consider in the oil sensitive basket. At the same time, what we have recommended to our clients, considering the market volatility and overall texture, is prudent that you should maintain 23,800 put as a hedge to your long position. So both ways means by reducing your exposure to the oil sensitive counters, at the same time hedging your positions, especially if they are leverage positions with the 23,800 put, is could be the strategy, especially to fight the overnight volatility that we are anticipating in the markets.
Ajit, Harsha, I believe you got that name wrong. Just give us a sense on metals. Yes, give us a sense on metals, because that's the pack which rallied the last time around when things went south with regard to the Strait of Hormuz. Nalco, Hindalco holding up fairly well in terms of the strength today. What would your favorites be? And broadly, if you were to buy the metal index today, do you believe that there's still some legs left over there?
Exactly. Means if you see the kind of rally that we had in the metal counters a couple of months ago, it was almost like a vertical rise, base metal. Bullions was slightly soft, but for the obvious reason, because we have had phenomenal run in the bullions in the recent past. So base metal selectively, yes, we are seeing sign of a rebound reversal, and within the pack means the metal index is currently Nifty metal index is currently hovering around medium term moving average on the daily chart. So probably we may see a rebound attempt. So National Aluminium, JSW Steel, Jindal Steel, they are relatively better in terms of the placement and the kind of price action that we were witnessing even during this sideways move. So selectively, one can definitely look for opportunity, but at the same time, keep a close eye on the performance of the underlying metals also, because we are not seeing broad-based recovery so far. So it might be the case in case if this thing escalate further. But as of now, a selective counter can definitely be considered.
Selectively positive when it comes to the metal space. Ajit, on that note, thank you so much for your time today. Thanks for sharing your views on the market and your stock-specific picks as well. But viewers, with that, we're completely timed out on this edition of Market Edge. From Harshmi and the team that put this show together, thank you so much for watching.